My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? Although I do have some special pals with me today, I do just want to help you make some money. My job is not just to entertain, but to educate, teach you, put it in context so you can understand it. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. All right, how the heck did we get up here with the S&P 500 hitting all-time highs? Dow hitting its high for the year after gaining 249 points today. S&P climbed 0.95%. NASDAQ rose 0.80%. And more importantly, does this market have what it takes to keep powering higher, regardless of what happens with the president, with trade, with the Federal Reserve? Just looking at the fundamentals of individual companies, which is what we do best in Cramerica, I think it's worth wondering what might happen if we stay on an even keel. We need to know if the market's gotten too expensive, sell, or if it's got more room to run.
All aboard!
Especially with oil having a monster runoff just today because of tension with Iran. So let's zoom in on the top 10 performances in the Dow Jones Industrial Average for 2019. See, we've got this. This will help us put it in context so we understand how we got up here and whether it is dangerous, whether it's safe, whether it makes sense. Number one is Microsoft. It's a $1 trillion household name with a stock that's up nearly 35% year to date. At these levels, now this stock trades at 26 times next year's earnings estimates. Sadly, that's lofty. It's a pretty rich valuation, which is unfortunate because we own Microsoft by Charitable Trust and always have to be concerned that it's moved up too much. On the other hand, the company has a habit of blowing away these estimates. Microsoft wouldn't be my first choice of these top 10 to go higher here. I think it's a quality company. I think that the stock may have gotten a little ahead of itself. No sin, that does happen. Number two, Cisco. Up 32%. Now, this is a brand new Cisco, people. The company has changed radically under the leadership of Chuck Robbins. The new Cisco is not just a networking company. It's also a play on the Internet of Things and on cybersecurity. Do you know it's the largest cybersecurity company in the world? Just buried within the housing that is Cisco, and it is doing fabulously. Best of all, even with everything it has going for it, do you know that this stock, it sells at 17 times earnings estimate. It's at a discount to the average stock in the S&P. And you know what I think it is? I think it is a steal. Buy! Third place, tougher for me because I love it, but it's rich as Visa, letter V. Now, it's up nearly 32% this year. It's not cheap. Trades at 28 times earnings. Honestly, I prefer American Express, even though it has some credit risk, or MasterCard, which is slightly more expensive, but has a faster growth rate. And that's why we own that one for our Charitable Trust. But that said, Visa, an erratic trader, prone to vicious dips, I think would absolutely be worth buying into one of those dips. Keep an eye on letter V. It trades wildly, and when it trades down, believe me, there's going to be nothing wrong with Visa. It is that well run. Thank you, Al Kelly, for doing so much for shareholders. Number four is American Express. It's up 31% for the year. This one's a keeper. American Express is exactly the kind of financial tech, you want to share that fintech stuff? Financial technology stock that money managers can't get enough of, and it sells for less than 14 times next year's earnings. Terrific franchise. I got it in my pocket. I don't know about you. Fed about to cut rates. This is among the most desirable stocks in the Dow right now. And I've got to tell you, convincingly,
all aboard!
Buy!
The House of Pain.
No.
House of Pleasure.
All right, number five. This is a tough one for me. Bob Iger, close your ears because you're not going to like what I say. Number five is Disney. And I like Disney so much, it is up more than 29% for the year. But when CEO Bob Iger laid out his plan for Disney Plus, the new streaming service, he gave you a growth roadmap that takes us to 2024. Since then, the stock has been on fire, rewarding bulls who stuck around like us when Disney was stalled out in the low 100s for ages. But at this point, though, you're late to the party, and I think it's a mistake to chase. This stock can come down to the 130s level from the low 140s, and then we get in the mid 130s because of a big sell-off off of China. That's when you pull the trigger. Sixth performer. Oh, boy. I know you don't want to hear about this. It's too boring. Stop yawning. It's the nameless, faceless, incredibly well-run Travelers, the big insurance company. Stock has rallied 27% for 2019. I pay Travelers. I pay them every month. I hope I never have to use them. Travelers is an excellent underwriter that's getting a real boost here because insurance companies tend to benefit from lower interest rates. I like the company for its sure-footedness, not to mention its cheap valuation. This one sells for less than 13 times earnings. What do we hear of its market so expensive? I don't want to hear about the market. I want to hear things like Travelers. I'm not enamored of the financials, but Travelers is a good company, and it sure wouldn't hurt to buy that stock right here, right now. Oh, boy, number 7 is hard. Maybe the hardest of the whole 10. Apple. This is a quandary. It's up 26% for the year. Remember, at the beginning of the year, it actually pre-announced bad numbers. Today, Deutsche Bank, good firm, okay, rolled out coverage on Apple with a hold rating. They're worried about a potential iPhone shortfall, and I can understand why. Apple's in the hot seat when it comes to the trade war. The company's a gigantic employer in both U.S. and China. It sells tons of product in both countries. Before Trump, Apple represented everything that was good about world trade. You got a great company with great products. It's working with everybody and making the money all over the globe. It was the quintessential worldwide company. With the trade war, though, Apple could theoretically be targeted by both countries. China could boycott Apple in response to the Huawei blacklisting. Trump could include cell phones when he rolls out the next round of tariffs of Chinese merchandise. And I do believe there will be a next round. So why do I keep telling you to own Apple? Why do I keep saying that? Why do I say own it, not trade it? Because this company is developing a fantastic razor blade business model where they sell you the phone and then make money for years afterward by charging you for subscription services. Plus, we're seeing real strength in the wearables business, especially in the watch, which has all sorts of health applications, by the way. You ought to try it. I love it. This is becoming a very large business within Apple's mosaic that they're getting no credit for whatsoever. Best of all, Apple trades at less than 16 times next year's earnings. So it's not like you're paying through the nose after its monster run. It's being valued as if they are going to miss the numbers. Number 8. I call it the despot. Home Depot, up 23%. Oh, I like this one. Like Walmart, like Costco, like Target, Home Depot's winning here because it has enough scale, Wall Street speak, for its real big to jawbone down prices. At 19 times next year's earnings, I don't think you're paying too much for what is one of the best big box retailers on earth. That said, the weather's been pretty bad for gardening season. Don't I know? I'm a gardener. Almost every weekend it rains. So maybe you have to wait for a pullback before you pull the trigger because it's been one of the leaders in the Dow of late. Oh, 9's a little controversial. Kind of a lot of people, I'm sure, thinking, oh, why bother? Well, that would be wrong. IBM, up 22% for the year. Here's a company that's with good dividend, by the way, good balance sheet, that's on the verge of a grand transformation. IBM is acquiring Red Hat, one of our favorite cloud-based software plays. It was actually one of our cloud kings, with the deal closing sometime next year, near the year, at the end of the year. In the meantime, IBM is paying you to wait, 4.7% yield. I would be a buyer of IBM. Finally, the Dow's 10th best performer is it's stunning. It's Procter & Gamble, up 20% year to date. Or at least Procter was the best performer until it was overtaken by United Technologies right at the end of the afternoon. UTEX, complicated story, breakup, merger. I like it, but Procter's simple. The consumer packaged goods company gave us terrific earnings and beat, and I bet it will be first of many to come of accelerated growth rate, good dividend too. On the one hand, I worry that we're late to the party. On the other hand, we got a 2.7% yield, benchmark 10-year Treasury today, unbelievably low, 2%. CEO David Taylor doing a superb job. There you have it. The large cap companies that are most responsible for the terrific run in the Dow. And looking at them as a group, I remain fairly bullish. That said, I think people have gotten too optimistic about the prospects of a trade deal, which is why I recommend waiting for that dip, which we're going to get before you build a position in some of them. Bottom line, there's still a lot to like here, but I'm right that I think these trade talks could break down. You'll want to keep some powder dry so you can buy into weakness and get some real bargains. Let's take questions. Let's start here to our left. Thank you.
Hi, thanks, Jim. My name's Amanda, and I'm from Connecticut. My question is on Ulta Beauty. Ulta's stock price has increased 42% from a year ago, but there's risk that the company won't be able to maintain its pace of growth. Q1 same-store sales declined year over year. And there's the risk of new entrants. Do you think Ulta's valuation will take a hit?
Well, remember, Amanda, first, thank you for that question. The rate of growth the rate of growth declined from previous, but it didn't actually decline. It's the rate of, as we call it. It's the second derivative. It's like calculus. I think Mary Dillon's doing a fantastic job. I think that she has a very long runway. I'm very close to Estee Lauder. They swear about these guys. Mary is amazing. I say Ulta is good. I don't want anybody to sell it, and I think that is an incredible. By the way, they have the best loyalty program of any company on earth. I like Ulta. Thank you very much, Amanda. Yes, sir.
Booyah, Jim.
Booyah.
My name is Todd. I teach a bunch of great middle school students in Ludlow, Massachusetts.
Fantastic.
They're always looking for ways to make money. GameStop used to be that way, but with streaming, gaming coming online now, what are your thoughts on GameStop? And what suggestions do you have for them to make some money?
I like Take-Two Interactive. You know what? I think that Grand Theft Auto is very good. I don't encourage it for my kids, but I recognize a great franchise when I see one, probably the best entertainment franchise in history. I think that Red Dead Redemption is very good, but I think that Strauss Zelnick understands this, and you also get esports. And you get, I know that it's down, people don't like it as much because of Fortnite, but that would be the one if you want a gaming. GameStop, no. Bad balance sheet. I mean, you go to the mall, you're the only one. Don't want to do that. Good for the young minds in Ludlow. Fantastic work. Thanks, you.
Jim.
Yes, sir.
Jim, big booyah from Scotch Plains, New Jersey.
There you go.
Close to Summit.
Yep.
All right. Tesla caught a downgrade today.
Yeah, you know, it's just kind of a reiterate. The guy just slagged a little more over the Model 3, but I hear you.
My question was around Elon Musk decided to cancel his Twitter account.
Right.
Been kind of a momentum play, as you know. So I'm wondering, without Elon at the Twitter handle, what are the implications for a momentum stock?
Well, it's a great question, and I've got to tell you that I'm glad that he's focused on making cars again and not just tweeting. You ever see his tweets? I mean, tell you, look, I get up at 3. Obviously, he's going to bed at 3, and he'd be like responding to my tweet. I'd be like saying, well, I don't know if I like this one. I have to say it's a cold stock. I want you to stay away from it. Look, people who love Tesla, the car, might want to own the stock. I believe the homework says the balance sheet's not good enough, and that was the genesis of that negative piece today. Thank you so much. Thank you, everyone. All right, if the trade talks with China break down, I need you to be ready to buy into weakness. You're going to get some real bargains that I just outlined for you on Mad Money tonight. Don't get too close to the stove. These stocks might be too hot to handle. I'll reveal the names just ahead. Then, could Caterpillar dig its way out of a trade war? Is there more to it than there used to be? I'm letting the cat out of the bag with the CEO. And it's a company that's up a whopping 100% this year alone. But can the move continue? I'm going to talk to the CEO of MongoDB and stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.